I was hoping to record it myself. So it seems like you're also recording. So that's awesome. Great.
Yeah, somehow I did that.
That is awesome. I was hoping to record it myself. So it seems like you're also recording. Oops. There's some back and forth was on the. All right. All right, ladies and gentlemen. Apologize for a few minutes delay. Welcome to the new Tax Clair series. Today we have our co-host with us, Chris Patton, CFO, one of the best guys that you can have in the DMV area. He's based out of the Northern Virginia, really experienced in different tax laws and tax structures. Today we're going to be going through the basics, but before we go, would love to know a little bit about Chris. Chris, really appreciate you being with us today.
Yusuf, it's an honor. I'm excited to be talking about this stuff. I'm just looking forward to answering some questions and how I can help people out.
Awesome. For everyone who is watching this, the series is going to be for our dedication to help at least $10 million in taxes for average American this year, 2023. We are going to be working our best. This is going to be recorded. We're also live streaming on our channel. So if you're not subscribed to either Chris's channel or MTR Groups, make sure to go ahead and do that. And in terms of the topics, the structure is going to be, of course, just a basic disclaimer. This is not a legal advice. This is absolutely for educational purpose. If you're working with us or working with any CPA across the entire United States, we're going to be giving you some basic level of knowledge so that you can have an intelligent conversation or intelligent decision with our people, with either ourselves or either whoever is working with you, and maybe work towards a better tax saving this year. But today we're going to be asking Chris about some of the basic questions on the entity structure, which is pretty much the first thing for any kind of decision making on what should be your structure and how you should structure it properly for the best tax advantage. So to start that off, Chris, let me ask you this. In terms of one of the very basic questions that I always get, what is the best entity structures? What would you say? This is I know it's a very vague question. I'm going to try to ask as a 7-year-old so that our clients or our viewers can understand this. It's a very basic. So even if it is a stupid question, if it comes from me, I apologize upfront. But I want this entire series to be very, very simplistic, yet informational, so that people can understand and grow with it. So I'll have you start with that, Chris.
Okay, well, first I've got nieces and nephews that are 7 years old, but they've never approached me about the entity selection. If they do, I'm gonna have to have a talk with my brother and sister to see actually what's happening. So, and really, there's no such thing as a stupid question. And what I say is, if your CPAs talk to you like you're stupid, it's time to fire the stupid CPA, because they're the ones who you got the pen out here and you're the one signing the check. So, don't sit there and take stupid, because there's too many of us around who can offer some advice. So ask the basic stuff. Now, you were saying about entity setup. Well, you know what? That leads to other questions. It's like, okay, how many of there are you? Is it just you, or do you have someone else? Now, the thing about it is, some people think, well, it's just me and my spouse, so we're basically one person. Well, the IRS doesn't recognize that two shall become one flesh thing. So it's going to be a partnership if it's a husband and wife thing. So just keep that in mind. So you've got things like a sole proprietor. You just kind of popping out and saying, all right, I'm going to start working on my own. You can use your social security number. Or there's the LLC, which has a little bit more protection because it creates a wall between you and your personal assets. So you have your business and then you have your personal assets. The LLC puts that wall in between. So if something happens in your business, and you get in trouble with that, they can't go after your house, your clothes, your car, your dog, what have you. Partnership is just the two or maybe even more of you that are coming together. And the big thing about that is that you are going to be responsible for self-employment taxes. But with an S corp, a couple things of that: no self-employment taxes, but you can pay yourself a salary, whereas you couldn't do that as a partnership. And then, of course, you have the regular C corp, Apple, McDonald's, what have you, which is the big one. You don't really need to start out like that, but always sit down with your CPA and say, all right, here's where I am. Be ready for any questions the CPA has, so they can guide you into the, okay, so here's the right thing to be thinking about right now. So those are the basics, Tusif. So what else can I tell you?
Awesome. So when you said, give me 1 second. Apologize for that. We're all human. We still have families. So if someone pops up from the back door, it's really real human. So you are speaking and listening from real human who have real life problems.
Yes, indeed.
So what you just said in terms of the first one you said was sole proprietorship, then partnership, and LLC, then partnership.
Yep.
And the first one you said was that needs social security number. What you mean is essentially everything reports of your business expense to your personal expense as well.
Well, what's going to happen is that when if you have a sole proprietor or an LLC, all the business stuff is going to be on the Schedule C, which is part of your 1040. And you don't have what's called an employer identification number. You basically can start and put on that form that my ID number is my social security number for the sole proprietor. It's when you get in the LLC and the other ones I've mentioned that you'll get an employer identification number, which you can get online at the IRS, that's where the identification number will change. But you always want to keep, and this is commandment number 12, you always want to set up a separate bank account for your business. So don't ever do things on your personal account. I've had clients that they've gone out and they put down a personal credit card to buy a computer. They got audited. The IRS said, no, you can't deduct that. Then they lose $1,000 deduction because the computer could be considered a personal thing. So therefore, they had a hard time convincing the IRS that it was for the business. So commandment number 12, always use your business account for your business.
Even if it is a sole proprietorship.
Even if it's a sole proprietor. It makes it easier for you to prove that, yes, this is for my business.
Okay. So one of the interesting thing is when I was reading about the IRS code in this area, the wording that it did have, one of the wordings that it did have was in business intent. Shed some light on that is, say, for example, if I went to, say, for example, someone flips house, a contractor goes to Home Depot, he forgets his business card.
Yep.
But he has his personal card. So he buys some elements for his business and some for his personal house. So I know he already messed up. He already broke the commandment 12. What is his repentance from the sin?
Okay. Well, so you're going to deal with the top five rules for that. Document, 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 document. What you're going to do with that, you got the receipt. Then you have, what you do is you prepare a memo for yourself saying, all right, I spent this much on my personal credit card. Therefore, I'm writing a check from my business to myself to repay myself for the items that were spent. You would attach the receipt to that, and you put it in your company file to make sure the IRS comes out, whip it out, put it down, and say, there it is. You can stop asking me questions about this.
Awesome. Let me put my headset on real quick. Can you hear me all right?
I can hear you just fine.
Awesome. You brought up a very interesting point here. Let's talk about the process of taking someone's money out in the sole proprietor and LLC. What you mentioned, something similar to as an accountable plan, I'm assuming.
Yes.
Help us understand what typically can someone do to set up one for his entity, and how crucial is this, and what practical steps one can do to do this without even breaking the bank.
Well, for an accountable plan, there is actually a memo that I have that I could to send if you want to talk to people. We can help you. Tusif and I can help you get that set up. And we also have a template that you can use that would allow you to transfer money from the business to the personal. Now, with an LLC and sole prop, or with a partnership, you are able to deduct your home office. There's a form on the tax return that you can do that for. But with an S corp, you can't deduct home office. So we use a thing like an accountable plan to make it so that your business will be able to repay you for the use of your home office. And it's a tax deduction for the business, but it's non-taxable money straight to you. So,
Awesome.
but what it can also be done I would also use a form if you're a sole prop or LLC or partnership to show how things are moving from the business into your personal account. Again, 5 rules: document, 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 document.
Awesome. So you brought up a very interesting point. I'm going to ask you about this home office deduction. Generally, we can not only we can write up the expenses, as much as I understand, we can also claim part of the depreciation of the homes if we do have the home office deduction. Help us understand, in case of partnership, S corp and C corp, since we're actually paying from our company, how does that deduction come into play? Depreciation deduction come into play.
How does the deduction come into play? Basically, you have the plan set up. You got a note in your file somewhere saying that, yes, I hereby set up the accountable plan, and therefore it is set on the mountain. And then you have the sheet saying, all right, here's the amounts. And it's almost like if you're a W-2 employee, you've had to submit a reimbursement request to your employer. Same thing, same concept. So that's how that's going to work. And for the home office, you're going to have a section on it, and then I have the spreadsheet, and it just has the items that you can do on there. Now, depreciation, if you're an S corp owner or a C corp or what have you, I don't believe that depreciation is part of that. That is something that we would have to sit down and look at the individual cases. But if you're an LLC or a sole proprietor, yes, you can take the depreciation on the house, but be forewarned that when you go to sell the house, you may have to pay some of that depreciation back. So keep that in mind. There is a simplified method if you're an LLC or sole prop that it's about $5 per square foot that your home office is, that you'll be able to take it and you don't have to worry about depreciation. I would love to see Congress just raise that rate, because that's been that way for the past 5 years. And I think there's been this little thing called inflation that has increased prices, but I don't know, maybe Congress doesn't know about that yet.
I really hope they realize that part real fast. But that's a great thing, of course, for people who are really busy doing a lot of work, which is the case for a lot of small business owners, who are pretty much the lifeblood of our economy. They actually, a lot of the times, don't have the time to figure out all the utility bills, all the mortgage statements. So what you just brought up is that simplified method of $5 per square foot, just measure it once, do that for every year. As simple as that. So that's awesome. In terms of what you just brought up in LLC being into the 1040. So say, for example, if someone's income has both W-2 and the Schedule C income, can his business losses start creeping in and taking deductions on his W-2 income?
Yes, it can. You're going to have a point where you can't, where you may be able to overtake your W-2 income, but that it is going to be limited by the amount of income. You can't have negative income on your on your tax return, and that would roll forward to prior years. And a lot of times I get asked, well, what if, I mean, if I have a loss, isn't the IRS going to come back and say, well, you don't have a business? Well, no, not necessarily. And you're talking about business intent earlier. If you're there and you can show that you're actually working a business, you advertise, I mean, basically, if you put on Facebook that you have a business, that's a good step. If you can show customers, you get a little book and keep a time log of what you're doing and show the activities. Set up that business bank account in the business name and to say, okay, yes, here's what I'm doing. Here are the activities I've done to show that I'm trying to run this business. So always keep that in mind.
Awesome. Absolutely. So what you just said is in most cases, even if someone like a lot of our people, what I personally had been doing is having a W-2, then starting a business on the side. So you were saying is there's going to be up to a certain amount I will be able to take from my regular business loss up until to my W-2 income as well.
Yes.
And if I understand correct, IRS allows you to take that loss up to 3 years. After that it becomes a hobby.
Yes, that is. So that's why it's important that you document your activities to show that you're actually doing this so that you have a basis to stand on. And if you have losses for 3 years or beyond 3 years, you've done something wrong. You do if it gets to year 2 or year 3, you really need to sit down with a business coach to get you going on this, because that's a long time to be losing money on a business. And you're not just doing this because you want to save money on taxes. You actually want to make money. Tusif and I are in this because we actually want to make some money and support our family. So,
absolutely,
yeah.
That's a great point you brought up. Is the moment it becomes 3 years, IRS says that, hey, you have had enough time to experiment with your idea. Either you start giving us taxes, or you consider that this is a hobby that's not going to be considered as any more business that you're going to take losses against.
Exactly.
And in terms of startup cost, so say for example, someone has those startups, what is that limit someone can take losses against up to?
From what I remember, it's 5,000. And Tusif, you can double check me on that. I've actually been up since 4 o'clock, so my zeros may be off there. But there is a limit that what you can do for investigating and getting everything in place that you can take during the year. Most of the time, though, when it doesn't take that long to investigate a business. So it's really, you're starting to think about it, and at this speed. I was talking to somebody last night, 22 years old. I'm in my 50s. If I had the resources that you have now, I probably would be in Bezos territory. So really, it's if you're looking into it and it's taking you more than a year to decide on the business, you may have been wasting your time. But speed is the key with this. So make sure that you're not kind of dragging your feet on it. Set a plan, get it in motion, and then go from there.
Absolutely. And if any of you guys are thinking that, if you already have a business and if you think you're losing money for a year or two, reach out to us. Chris and I both are CFO. We can actually even look at your financials, understand what is causing that loss in the first place, and then we can suggest you elements that would actually make you from negative to significant positive and even grow it to multi-million-dollar business possibly. And I know Chris is great at his accounting skills and also his number skills. And we would love to help anyone and everyone out in this regards.
Absolutely.
Awesome. So let's go back to the aspect of partnership. I know you spoke a little bit about the sole proprietorship B and LLC being just a regular Schedule C, while the partnership is going to be something different. Walk us through what's going to happen if someone were to start a partnership. So say, for example, I bring in the money, someone else brings in the expertise. how would someone structure that that's going to protect both of us and also is going to be most tax efficient?
Well, Tusif, I'm going to go back to high school. I had a business teacher, Mrs. Cohn. She was ancient when I had her in high school. So God rest her soul, because she's probably gone on to her reward. But what she always told us was that you never enter into anything without a solid contract. And we jokingly asked her, well, what about if it was your husband? She says, yes, even if it's my husband, I'm going to have a partnership agreement drawn up. So when I talk to my clients, like, yeah, I'm thinking about going to business with my friend. I said, you need a partnership agreement. Well, yeah, but after, no, 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 no. Get the partnership agreement in place first, because friends can turn into enemies, wives can turn into ex-wives. Tusif and I will never have that problem. Um, but you want to have that agreement in place so you know how everything's being divided up. Then you can talk to your CPA and say, all right, here's how things are going to be divided up. Let's get it set up so that everything is documented ahead of time. So you will decide when we're sitting down and talking about the partnership, we will know how to report it on your taxes, that this person gets this much of the profits and loss, and here is your balance going forward as far as the equity contributed is this amount, and then profits are added to it, losses are subtracted to it, and then how what's called capital contributions. More, the person who put in sweat equity may decide that old Aunt Ethel died, and they're going to put in $50,000 to help fund a company, and that's going to change the equity, and that should be also be in the agreement. So again, most important thing, get a rock solid partnership agreement, even if it's your very best friend since nursery school. Get that in place.
Absolutely. To be honest, I actually lost a lot of people as great friendships just because things did not go well and we did not write things up.
Yep.
We did not write things up in a way that, hey, we're getting into this partnership. This is going to be what your role is. This is going to be what our role is. This is your expectation. You can expect this from us. This is something that I can expect from you. And that's actually why, even though you and I have other practices, our personal practices, that's why I love to that partnership draft, send it out to you, even before we actually started this journey together.
Yep.
I know it's more of helping people, but even in helping people, when things does come into return, I don't want money to be in a reason that loses our friendship.
Absolutely.
So that's why contract is a great thing. So in terms of partnership, you just mentioned that someone can contribute to the capital, someone can do the sweat equity. What happens if that capital is distributed in a way that whoever's giving the capital is returning it? That's going to be the first thing out. But after that, whatever is distributed, what happens in the tax situation in these two scenarios?
Okay, so if you basically the person puts it in money and then they withdraw it, well, hopefully the business is making money, so their capital account is going to be increased by the earnings that have come in, based upon however they decide it's 50% me, 50% you, or 90% me, 10% you, or as Boss Hogg would say, 50% of 50% of 50%. All my 80s kids are going to understand that one. So it's really going to be okay. Yeah, you can pull all your money out, but if you're bringing money in that is not being distributed, your capital account is going to grow, so that will stay in there. The only issue you may have is that if you have you've contributed money, but you keep having losses, so much so that your capital account is down to zero or below, and you still have losses, you cannot. The losses will be sent over to your personal return through what's called a K1, and you will not be able to take those losses if you don't have any equity in the business. So, I mean, I've had clients say, well, I lost all this money. How come I can't take it on my return? Because you don't have any equity in the business. So you need to have something, you need to have the equity in order to be able to take the losses. Now, does
That
that
is
answer your
awesome.
question? Or you want to expand on that a little bit?
Absolutely. That brought up a very good point, especially on the equity part. So this is something that I actually also face personally, where two guys drafted up, especially me being in the real estate investing side myself, two guys drafted up something, but just because someone did not have legal equity of on the entity structure similar to the other individual, even though he put down the money, he could not take the full loss, which was really, really interesting aspect you just brought up. So whenever you're doing that, make sure to understand that you need to have some equity, skin in the game to get those losses. So let me ask a follow-up question on that. So say, for example, there's a multi-member LLC, which is pretty much the same thing as a partnership with some corporate veil. If someone were to be an owner of, say, for example, 25%, the other individual is 75%, even though the 25% owner brings 100% of the cash, while the 75% owner brings all the sweat equity, excuse me, when the distribution happens, can he take the full deduction on his regular income that's going to flow through to his 1040?
Yes. So what happens is that's not a entity-wide decision. It's each individual partner. So if you have one partner who they've pulled money out, so they have zero equity, and there's a loss in the business, well, he can't take that loss. But the other partner kept his money in, and the loss isn't as much as his investment. Yeah, he can certainly take that loss on his personal return.
Awesome. So you just brought up something called at-risk rule by
Yep.
IRS. So you can take losses as much as you have risk into it.
Yep.
So let me ask you this in the follow-up question, because I have a lot of people who does private money lending.
Yep.
So what happens in this kind of situation? So say, for example, there's going to be a property to buy. Someone is raising money from the private money lenders, and they lend money, but they also get the money back. So when the property is sold, say, for example, I'm going to ask both of this positive and negative scenario. So the positive side, when everyone is making money, so say, for example, I lend someone $100,000. 6 months later, I get $150,000 back with return and interest. On the sale of the property, who actually flipped the property did not put any money into the deal. How would that taxation work? Now, in this case, both of us made $50,000 on top of one having $100,000 and getting $50,000, another not putting anything but $50,000. What would be the tax consequence on that case?
Well, the person who didn't put in equity, that would be a basic, almost like almost compensation. So it would be, they would earn it. And hopefully you set this up in a strategy. You talked to Tusif and I, we got you set up something where we're going to minimize taxes. But we would be able to get it so that, okay, so this is going to be basically your earnings, basically as if you're getting a W-2, as basic as I can make it. But the person who invested the capital in there, they bought something, and they would be able to take the gain on that, and that would be capital gains, and would be able to do that at hopefully if it's been more than a year, you use the long-term capital gains rates, which are usually around 15%. But if it's just shorter term, 1 year or less, it's going to be at ordinary income prices. So it almost, if it's a short-term thing, both people are almost going to be the same way.
Yep. So of course, if you're flipping, definitely don't consider this as for the viewers, don't consider that as a capital transaction, because flipping is a commodity transfer.
Yep.
But if your intent, as Chris was mentioning before, the business intent. If your intent was to hold it and you ended up, hey, we got a better deal like we had in COVID, the appreciation was so huge. It's an irresistible deal. You had to sell it, but you need to realize that if you don't have a strategy in place, you're going to end up paying that 37% tax if the highest tax bracket.
Yeah, but talk to Tusif and I before you make that, because there's things like 1031 exchanges where you just move from one property to the other. So
absolutely.
don't sell it just yet, but just sit down, talk to your accountant. I tell my clients, look, I'd rather have you ask the question, even you may think it's stupid, but I have dealt with what people consider stupid questions all the time. I'd rather ask be asked a stupid question than get a stupid letter from the IRS saying you screwed something up. That's the stupid part. So hey, ask me anything you want. I was telling Tusif that I was at a local high school talking to young ladies about they were in a cosmetology class. They're going to go into business for themselves. And I said, look, ladies, this is going to be really the only time you're going to get free advice from a CPA. What questions do you have? A young lady raised her hand and said, if I got a dog for the salon, could I write that off? And I actually was about to answer when a teacher told her, look, no, that's against the Board of Health. You can't do it. I said, okay, well, there you go. It's illegal. So you can't write off things that are illegal. That's what got Al Capone in trouble. So, but ask the dumb question, because you never know when a dumb question is going to be quite insightful, and make sure that you have your bases covered. Our job is to protect you, to make sure that you are not harmed by what your situation is, or do the best we can with it.
Absolutely. That's a great point you brought up, is what is illegal is not deductible.
Yes.
Even if it makes sense, if you're doing something illegal in any legal business, that is not deductible. Don't bring and take that to your accountant or CPA and go get all of you in trouble.
Yeah. But if you get income from an illegal activity, that income is still taxable, but you can't write off any of the expenses from it. So, yeah, it may not be unfair, but look, don't break the law. Really, all I can say.
That's a very interesting thing. When I first saw that there is a line item for you to declare bribe income.
Mm-hmm.
So income from bribery, income from gambling, even though these two are morally not the best thing, IRS still wants you to write them off or even declare the income. As a matter of fact, in the gambling side, you're going to get a separate form.
Yep.
Even if you're going to Vegas and did whatever on drugs, you are going to get a tax bill.
You certainly are. Even the old ladies you see going to play bingo, and don't mess with an older woman playing bingo. Don't mess with that. You're going to get a tax form saying this is how much you've earned. It's a 1099 that you're going to get. But yeah, report that on there. And yeah, I heard about the bribe thing, and I always scratch my head going, well, basically you're admitting to committing a crime. But hey, stranger things have happened.
Awesome. So let's go into that part of what you earlier touched is on LLC and sole proprietorship. You spoke something about the self-employment tax. And you said that we can actually not take that on the S Corp and C Corp. Let's talk a little bit about that. What is the Social Security? How does that work out? And how does someone benefit or even have something to deduct on that?
Okay, so what happens is that when you're working a W-2 job, you open it up and you see the federal income tax withheld, then you see Medicare and Social Security. So your employer's already withholding that. Well, now you moved out and your employer is now you. So now you are the person who has to withhold that. So the self-employment tax is the 15.3% is going to be something that's put on to your tax form if you're sole prop or an LLC, so that as I say, the IRS gets their pound of flesh no matter what you do. So that's what's going to happen on there. However, if you're a S corp or a corporation, what's going to happen is, yeah, you'll be able to be on salary. You can't be on salary if you are a sole proprietor or a LLC or a partnership. Partnerships have things called guaranteed payments, and we'll deal with that in a future podcast here. But with an S corp and a corporation, you're going to be able to W-2 yourself, as I say, have those taxes withheld, and then the company will match the Social Security and Medicare, and you as a company will be able to write those off. And the great thing about it is that you probably will end up paying less in taxes by choosing the S corp and or the C corp, because the taxes, the self-employment taxes, are going to be taken at the paycheck level and also going to be matched. So you're not going to be hit with this big tax bill right on April 15th. You're going to be hit with it during the year on much lower income. And you'll end up, there are a lot of S corp versus LLC calculators out there. Make use of them and see, all right, here's how much I can save by switching to an S corp or maybe even a C corp. So it's a discussion you can have with your CPA to make sure that you are on the right track so that you're not paying too much money.
Awesome. As a matter of fact, we opened up this discussion regarding some of the questions that we will answer. And one of the questions that came from Teresa Wilson, a great friend of mine from New Jersey, really interesting lady. She's a real good hustler. She asked a very interesting question that she is now having an LLC that makes zero income, but she has a potential deal which could produce over $1 million. That's a huge jump. So think about one deal making $1 million. We actually had a conversation with her earlier that, hey, if you were having an active income, do consider switching it to a corp. That way, when you're taking money out, that's a very interesting topic we're going to talk about in much detail in the future ones. But just to touch upon it, when you're going to be taking money out, you can actually pay much significant lower amount of taxes by switching to corp, especially in some cases, if it is that much, more than 500 grand, to C corp, that is going to limit your corporate taxes to 21%. And that instead of like S corp or LLC, it's just going to be that up to 37% at that much of income level. So of course, it's not going to be the absolute answer, Teresa, but it's going to be more of a high level situation. Whenever you're going to be taking money out, that's going to be a significant concern of yours, especially the LLC having the opportunity to convert from disregarded S corp and C corp in the tax form. So that's a great question. Appreciate the question. In that case, let me ask you this, Chris, in the follow-up. What happens if the owner does not take money out? How does the tax work for LLC, S corp, and C corp if he's keep reinvesting into the business?
So what's going to happen with, I will say, with an LLC and an S corp, what's going to happen is that, okay, that money can sit there and that's fine. You will be, if you've made the money, you will be taxed on the earnings when you earn it. But once you're taxed on it, that's it. They won't tax it again. And it really depends on how it's distributed to you. And that's something that sitting down with your CPA and looking at the individual situation to see, here's what you're going to be looking at. However, with a corporation, there's something called an accumulated earnings tax, where they want you to make sure that you're not just kind of hoarding the money so that it doesn't get distributed out to you and you're not having too much in there. And I think the level there, Teresa is looking at $1 million payday. I think the level's at $5 million. So Teresa, you got a couple more big deals before you can hit that threshold, and I hope you get there.
Awesome. That's a great point. Is if you are just hoarding money in LLC and S corp, it's not a big deal. But the moment it becomes a C corp, you have to consider that $5 million hoarding money period. So let me ask you this: if I were to have a C corp and buy other businesses with that $5 million inside that C corp, will I be still taxed on that?
So if you took that $5 million and you used it to buy other corporations, well, you're making it, that's a really good question, and it requires some strategy sessions to look at it. But if the money has been distributed for certain uses, then no, I do not believe that that would apply. But again, let's take a look at your situation to see what's happening and how the rules apply. And maybe it's not worth buying those other companies because, you know, maybe you don't want the bad hot dog that's going to make you sick.
Absolutely. So if someone needs to understand if there is a company that is profitable or not and what price point it would be worth, let's have a conversation. We can definitely look into the finances, see if this is going to be something that's even worth it to have part of your C Corp in the first place. And
Yep.
then we can have a conversation of if that distribution, what would be the best way to take the distribution in the
Right.
most
Now,
tax efficient way.
when I talk to my clients, is that okay? They always ask me, well, how about what's the way I can save money on taxes? I said that's the wrong question. I always hold up a quarter, and I always hold up a dollar. Say, you got a quarter? So yeah. Will you give me this dollar for that quarter? Yeah, I'll take that dollar all day long. Well, instead of just thinking about the taxes, how is this move going to help you bring in money? We were talking about buying the businesses. I worked for an electric heater manufacturer maybe 20 years ago, and we bought a air conditioning company, which made sense because you sell the air conditioners in the summer, you buy the heaters in the winter. So we could even out the earnings through the year.
Yep. Awesome. So in terms of, so as you just brought up, the accumulated earnings. So instead of earning being accumulated on the C Corp bank account, say for example, I have a C Corp, I have a business, active business, just like Theresa, we're making a lot of wholesale deals, flipping deals, real estate commission, whatever. But I realized that if I have $5 million, instead of me taking a loan from the bank, I could actually take a loan from my C Corp. So, but if I loan it to my another entity, say for example, instead of me taking a distribution out as an owner, I open up another LLC that's going to hold that property. How would that work that I can take loan from my C Corp? This was actually from another very interesting friend of mine, was actually buying a property recently who also have the C Corp, and he's actually buying an LLC, a property in LLC. How can he actually take that loan so that it's not going to be taxable event as a distribution from his C Corp?
Okay, so if he's doing it for his own personal uses, then there are rules around it that you have to repay it within a year unless there's certain circumstances like you're buying a home or other ones that we certainly can get into. But if it's being loaned to another business, that's something else entirely, and you want to make sure that you're paying a market rate of interest between the two entities, and that everything, again, the 5 times I said document the transaction so the IRS doesn't have any questions about it. But if it's business to business, it's different than business to personal. So that's just making sure that it's between two businesses, and they would see that it's a loan, and loans are usually not taxable. So just making sure that you treat it as an arm's length business transaction and document the heck out of it.
Absolutely. That's a great point you brought up, is even if I wanted to say that, hey, even the both of them are my entity, just because I loan from one entity to another, IRS is like, no, you cannot do it at zero interest.
Yes.
There is something called imputed interest, which is an integral interest that even if it is a zero interest, then IRS just comes in and says that, hey, this is the interest you should have charged. You have the option to charge, so we're still going to charge you. So what you just said is, say for example, I made $2 million as a C Corp this year, and I said IRS that, hey, I'm actually going to loan out $1.5 million to another business to buy that property. who is going to be buying the property, whatever it's going to do. But I'm going to have a document drafted up, legal document with both entities' elements that's going to say that this entity, that's LLC, is going to pay with interest back to C Corp. The good thing is the timing. One of the best things about taxes is the amount, the vehicle, and the timing. These are the three main elements on tax plannings. And C Corps has the unique ability to shift their tax years, which allows them to loan. So on the books of the C Corp, it is showing that, hey, I'm going to be paying IRS tax more with interest with the money that I'm going to have next year, but this is going to be deferred. But when it comes down to the LLC, when it is returning that money, it has to return with interest. And even if it is zero interest, ours is going to come for that amount with some interest, that's imputed interest. But the best part is that taxable amount deferment, if you can put it in proper placing, proper timing, it might just save you taxes in specific years. And when you couple it with other elements, that's when it becomes really powerful. I know we're going to go over those in future ones where we're going to discuss more about the tax strategies. I want to keep it really simple about this one. So that's one of the answers that was there. Another question I'm going to take from my brother, Tech Chang, a great individual making a lot of money in real estate. He wanted to know about the tax breaks on the short-term rental loophole. I know this is not part of the entity structure, but I'm definitely going to have Chris touch real quick. What is the fundamentals of the short-term rental loophole? How can someone actually take benefit off of that loophole? And is there any benefits with difference of entity structures for the business owner?
Well, with understanding the benefits of it is there. It really depends on how long the person's going to be, your renter is going to be renting it. You can do things like taking a depreciation on a property that you own. You actually have to own the property. But that also leads into things like cost segregation. So if you bought a property and you normally just, okay, you bought it for $800,000. Okay, great. You would take that over 27 and a half years. Well, wait a minute. That's just the building. You could have something with some things within that property that you could depreciate over a shorter period of time that allow you to take more depreciation than the 27 than you would if you were just taking everything at 27 and a half years. So those are some big things to look for, is that it's I mean, the thing about it is that we're looking into passive versus non-passive, and really what you're doing, if you qualify as a real estate professional, you're spending over 50% of your time on real estate activities and spending more than 750 hours on a year on that, and it's your code. And if you have losses, you're limited. Everyone's limited on the passive losses they can have. It's up to $3,000 a year. But if you are if you have qualify as a real estate professional, you're able to do a lot more because they will let you take quite a bit more in those losses during the year. So that's something to look into, is becoming a real estate professional. You basically you do a letter, you attach it to your tax return to say, I am a qualified real estate professional. I swear these things are what's happened. So I'm allowed to take a bigger capital loss this year because I am a real estate professional.
Awesome. So just to give a little more background on what Chris just mentioned, is on IRS's perspective, rental activity is passive income. And on a very broad stroke, you can take passive losses against passive income, active losses against active income. Now, the real estate being one of the biggest king of deductions with depreciation, as Chris mentioned, with bonus depreciation, when you can actually accelerate the elements of different elements of your property with the cost segregation study, you can actually allow more depreciation in a particular year to offload your tax liability in that particular year. And he brought up a very interesting thing. The real estate professional status it's a very explicit element in IRS publication 925, if I remember. If you qualify for those, the entire passive activity becomes an active activity. So it means is previously, if you were not having that qualification, even though you had a lot of deductions, if you make more than $150,000 a year, you can only take up to $3,000 in deduction. But if it is between 100,000 and 150,000, and you own more than 10%, that becomes up to $25,000 allowable limit. But the moment you go to that short-term rental, which is less than 7 days of average stay, and more than 100 hours of you actively participating in it, that becomes an active business, not a passive investment. So the moment you change that category, you need to realize the fact that all the depreciation now becomes part of your active income. So you can take as much as depreciation you can with bonus depreciation and cost segregation against your active income. But the caveat to it is if you're structured with the sole proprietorship LLC, you're now subject to self-employment taxes again. That's where it becomes really interesting on how you structure your entity cascading. Maybe you have some part of it as a corporation, some part of it as LLC. There's a lot of different elements. We're not going to be going into that level of intricacy at this point, but definitely that is the overall element of what Chris was trying to mention, is the fact that your income becomes active from a passive investment, that allows you to take a significantly higher deduction than any other income. That's awesome. And second part of that question was, is there any additional way to have any strategies other than cost segregation to tax break to offset the W-2? Tech, there is, but there is not a lot. I know Chris can talk much more about it. Is unfortunately, IRS punishes W-2 employees with taxes.
They do.
So there's few of them. Of course, you can probably take care of the capital gains with CRT and ILS and stuff like those. We're not going to be going into those details today, but one of the biggest ones is if you just full load your retirement accounts, that's just going to not remove it, it's just going to defer it. The only thing is, if you want to have a foundation, and charitable foundation or whatever foundation, you actually can contribute up to, depending on the type, properties is 20%. If it is not public use, if it is, then 30%, depending on the category and the tax year you're in. And in some cases, up to 60% as cash value. That's some of the only few big breaks I can see. Chris, if you want to add something to it.
No, Tusif, I think you covered everything, and you're right that the W-2 employee does get hammered by the IRS and does reward the business owner. So really, now's the time to start thinking about starting that business and seeing how you can build your life by using your business to pay for things. And we can talk more about that in future podcasts.
Absolutely. I have to ask you in this regards, is now, I know it's almost towards the end of the year. Say, for example, someone has been experimenting with all of the things trying to make connection, investing here and there short term. If someone wanted to have an LLC formed today, now is the 11th day, can he capture the expenses he made maybe in February, March, or April?
Yes, just keep track because you started the business, you just converted it over to an LLC. And really is all that's happened is that you went from doing it under your social security number to under an EIN as an LLC. The LLC, I think I mentioned earlier, all it does is it divides the line between your personal and your business. So you're going to use the same tax form, the same tax rate, same self-employment rate, but make sure that you get that EIN number. And yeah, it's going to be what you are at the end of the year. And if I could add something that I would love for our LLC owners to do, sole proprietors, for the end of the year, is get yourself set up with a self-employed retirement plan, because that's going to be a huge write-off for you. That doesn't you don't need to put money into it now, but if when I do your return, I can tell you that, all right, here's how much you owe, but if you make this much of a contribution to that retirement plan, your taxes will go down to here. So, but you have to have it set up before the end of the year. So talk to your financial advisor about getting that set up. That's the biggest tax break I can tell you to get done before the end of the year.
Awesome. I think it's if it is husband and wife partnership, you can do up to 120,000, 132,000, around that.
That sounds about right.
Yeah, that's one of the biggest things that you could potentially do if you were 1099 as well.
Yep.
Make sure to set up a self-employment retirement plan. I know you cannot touch it, but if it's structured properly, you could probably take a loan against it. Like 401k, sometimes in most cases does allow to take a loan against it. And you can actually use that to invest into other stuff, but your tax hammer of about $120,000 is reduced to maybe you're probably going to be hammered instead of by a steel hammer, probably by a wood hammer. It's way better than that in the previous case. Awesome. I know we have gone a little bit over time. We are going to try to keep it short and sweet every single day, every single show. For anyone and everyone, we are planning on continuing about these every Wednesday and Saturday, 8:30 p.m. to 9:30 p.m. Eastern. If you have any questions, feel free to reach out. We are going to have our conversation links down in the description. If you have any other questions, Chris has a wonderful service. He's also local, father of 2 wonderful children and a husband as well. We're both family oriented. So if you really want to have a conversation with someone who is a real human as opposed to a corporation, who understands the feelings, challenges, ups and downs in life of business, just book a call. Let's have a conversation, and let's see if we could help you out in your journey towards a higher tax rate. With that, I really appreciate and thank Chris for his time. I appreciate everyone who asked the questions. I hope we were able to clarify some. We will be continuously going over those in depth in the upcoming episodes. And I thank everyone for the participation. And again, Chris, thank you. If you have any last closing statements.
No, just keep hammering away, document everything, and make sure you have that bank account set up as well as a self-employed employee retirement plan. But we'll catch you on the next edition.
Thank you very much, and have a good night.
Good night, y'all.
Bye.